All right. Let's see. Change this over to well, bam. All right. Hello, hello. If you're watching, I'm K-Brot. This is 51% attack. That sounds so professional doing a title. Oh, a little hot on the mic. Let's turn that down just a tad. Okay, that's a little bit better. All right. Yeah, I've got my apple juice. Um, oh, and apologies to the first meme maker, Bink Video, who made a lovely. Oh, I wonder if I can find that. Find that later. Uh, the apple juice is actually 18 years aged, and your meme had it as 12. I know I said 12 the other day, so my apologies. You don't have to remake the meme, but anyway, um, yeah, got my liquid courage again. Let's dig in. First up, man, that was a lot of volatility today. Um, and yeah, it seems like it's coming from probably the Bank of England, the interest rate decision that went through yesterday. Um, you can kind of see overnight. Oh, look, the charts got the correct aspect ratio. Yay! We kind of saw the very first hint of today's action on the overnight with both the futures and if you follow the FTSE, the UK 100. It was the first thing to go, and yeah, U.S. futures fell with it, and then U.S. indices went right along with the futures. So yeah, we could have been a little bit more ahead of that, but you know, what are you going to do? Everything was following the Fed. There was no reason to think that markets could have just already priced in the Bank of England in addition to what the Fed had already discussed. Papa Powell with his 75 BPS rate hike. But Bank of England, I guess, had a little bit more pull. And so another thing that we need to look ahead to is it's actually oh god, it's actually in an hour. Is the Bank of Japan interest rate decision? So this could very well happen during the stream. We could see price action on the stream. Is all I'm saying. We'll have to keep an eye on that. But yes, Bank of Japan is as I was kind of talking about with High Flyer earlier today. I'm not an economist. I do not have a degree in it, but the general idea is that Japan is oh yeah. Sorry, I'm just looking at chat. Yeah, we'll talk about 3AC for sure. At least my understanding of it. So, real quick with Bank of Japan. So they're in a similar position to the U.S. Fed, but what looks to be about 6 months back. If you were in ETH Finance last summer, you saw me, screaming my head off about about inflation, and the markets were not matching what was going on with inflation, and we got that amazing dead cat bounce into November, and the market peaked. But that seems to be where Japan is right now, because they are currently in the process, or sorry, they've been in the process for a few months of just buying just unlimited bond buybacks. Very, quantitative easing to the nth degree. The issue being that Japan is both larger than most other banks, around the world, but also not large enough to carry that kind of breadth, that the Fed was somehow able to weather in the U.S. Not to get too political, but should the Fed have taken on that much weight? Who knows? But clearly, it survived an additional 6 months into the market peak. But Japan is a bit on a wire, it seems, at least from what I've been reading. Whereas Jerome Powell and the Fed governors were kind of navigating, well, what would these interest rate hikes do to both inflation, as a tool, as a weapon, and to the markets themselves. Japan is holding so much weight in their own bonds that apparently I was reading if the rate goes above 1%, which they'll eventually need to combat inflation. It's the same there as it is anywhere, but apparently going above 1% would liquidate an incredible amount of bonds a lot of which are held by the Japan Central Bank themselves. What I've been reading was, I don't think it's on this page, which is the trading economics calendar. Um, but Japan has somewhere like it's like 29 trillion, 30 trillion yen. That would be worth less than their hold. The bonds would be worth less than their holding. So 29 trillion yen or something. I believe somebody converted it to like 200 billion US dollars. Just to put that in perspective, that's a massive that's a massive loss. And so again, things are going to happen potentially in an hour if the calendar is correct. Um, I believe this has, yeah, 11 p.m. New York time. So 45 minutes until potentially that decision if this calendar is correct. And it's usually pretty on. Um, and then as far as the contagion goes, Japan has been at the head of two large crises, in the past, 40 years, where you've got, of course, the Nikkei crash in 1989, which was very, very localized, but had far-reaching ramifications. I'm too young to talk much about that, but obviously it lasted longer. It took until 91, 92 for even and the Clinton administration to sort of claw out of that. And then 1997 with the Asian financial crisis. Of course, Bank of Japan was involved in that, and that was much more localized, much more short-lived. And so yeah, we can take a look at that. Later. I'm not. That's well outside my scope, but I know people were asking about it, and so we're gonna have to see. We could see in minutes, the start of this thing, or it may take a few days. Well, let's put that on the back burner for now because I'm not super confident in it. um, so anyway, that's the trading news. Or sorry, that's the calendar, not the trading news. I guess it's also news, but that's really what we have in terms of major events that are scheduled. There's also, of course, tomorrow is Friday. It's the third Friday of the month, which means options expiry. And not only is it the third Friday, it's the third Friday of June, the end of quarter two, which makes it not a regular old triple witching, but a quad witching. We've got individual stocks, their options expiring. We've got indice options expiring. We've got individual stock futures expiring, and we've got indice futures expiring. All four. That makes it a quad witching day. Which is to say, I mean, we can check out. Yeah, I don't have a ton of numbers to share because I'm not logged into. I don't have any like premium services, but we can sort of take a look at what the implied volatility is for tomorrow and see like what max pain is. That is not helping us. That is completely off. Okay, that's not to confuse people. Let's not go into that. Anyway, it's just to say big volatility is coming our way tomorrow. You've got, if you take a look back at the last expiry, let's go to the SPY, which is currently on an hourly chart. Oh no! Oh, this one's sorry. My chart is so messy because I kept these lined up. We'll just go to the full fat, the S&P for now. So, what happened at the last quad witching? You can see like you had funds just pouring into the market, trying to make okay. let me qualify this. I'm speculating. I don't actually know what hedge funds are doing, but I'll tell you what it looks like. Look at this rip from the March bottom or close to the March bottom into the end of the quarter, and it's just making to me it looks like they're making their ledgers, not not the hardware wallet, making their bankrolls, their papers look real good for the end of the month, and then they sort of allowed the weaknesses in the market to take place and take advantage of that. And well, I don't have to explain to you guys what Q2 has looked like. So how can we use that information to maybe figure out what's about to happen both in the next 24 hours and beyond? We were off. The markets are on a downward tear, and how does this? I'm basically thinking this through live with you guys. Is it that they're able to sort of close their books way down, buy assets for cheap, and then build up their portfolios again and sort of let the year rip? That seems like a potential scenario. But my point here really is that these days, options expiry Fridays and especially end of the quarter quad witching is just a playground for whales, for manipulation, um, and for again these hedge funds, for market makers to hit their numbers and to fake out people who are looking at those numbers from the outside, myself included, myself and you. Like I don't know what's going to happen. All I know is volatility is very likely on the books for tomorrow, and so we should just keep that in mind. It's going to be a wild day, and I do want to do another stream, hopefully tomorrow, maybe the day after, to get a lay of the land after we're through this crazy, crazy week. Again, we've had the Fed, we've had VIX expiry, we've had Bank of England, Bank of Japan. It's going to be quad witching. What a crazy week! If you make it out of this, man, get a drink. Join me for a drink if you make it out of this one. Okay. Okay. I guess real quick. Let's talk about the 3 hours capital just before getting into the charts, because the charts aren't really moving right now. I mean, I was going to stream a little bit earlier, but it was before the markets rolled over at 0 UTC, so there wasn't much point to that. 3 hours capital. Yeah, I mean, I'm reading the news. I'm into it. I'm not an expert on this. I would love to get additional info. You're more than welcome to put it in chat. It just seems like, yet another sort of, not only just a crypto hedge, a crypto focused fund, which is of course what they are, but like in terms of the contagion, I was reading that they're involved in several other, they've got their fingers in a lot of pies. They were forming the basis in terms of funding for several other protocols. I don't remember if they were named. I'm not going to go back through Reddit right now. Somebody in the ETH Finance Daily was kind of pointing to either tweets or something like that, something unsubstantiated, but that sounded really good, that listed some of the protocols they may have been involved in. And all I can really bring to this, because again, not a hedge fund person, and I don't know enough about that many protocols, especially the newer ones requiring startup funding. But this all smells to me like a speed run through the great financial crisis, in that, one domino, a large domino or several dominoes that were backed by a very small number of, basically what I'm trying to get at is more mortgage-backed securities, and what happened, during the financial crisis. One domino leads to another, and eventually, if one person can't pay back the other, and that other was working on a protocol for another, man, all these DeFi Legos. I don't know. I think that and this is just me talking, personally. I think the ecosystem is strong enough on its own where whatever those protocols are, there's going to be other Lego blocks to take their place. Obviously, we've got incredibly strong things. You've got, of course, Maker, which is just, the bedrock of DeFi. Maker, Curve, all that kind of stuff. They're not involved. They'll be fine. Somebody who's bringing, I'm in the Rye gang, man. I love Rye. And Reflexer. So I like to see them, which is the truest of, decentralized stables and cryptos. Man, stuff like that. It's going to be here for us. So if everything collapses, it'll come back. And that's kind of my take on it. And I'm a layman when it comes to that sort of thing. But as far as 3 hours capital, it feels a little bit like 2008 on a speed run. And let's rip off that Band-Aid. I know we keep saying that. I've been in this space for years, and we're always talking about, like, let's rip off that Band-Aid and let's get rid of the weakness and get stronger. Hopefully that happens in this case. I know the last thing I saw was somebody was speculating that FTX was bailing out 3 hours capital. So I don't know. That's unsubstantiated. So I'll leave that one to other people. What else? What else is in chat? Mr. Gway, ZK Gway. Did I watch the Fed meeting? Of course. How do I feel about JPOW statement? I feel about it the same way I always do. I don't know if you're joking, because I was commenting in ETH Finance Daily and doing my usual. I wasn't actually drinking at the time, but there's definitely a drinking game to be had whenever Powell's on stage. I mean, he's just look. They all do it, but he is the master of just vagary and avoidance and just clown ass comments. I mean, it's his job to do it. Obviously, every month or every other month, he's got reporters going, trying to get a bead on like the future of finance. Uh, and they're like, they'll try to couch their question like, Chair Powell, thanks. Hey, what's the interest rate going to be next month? As if he's going to tell you that, Jeffrey from Yahoo Finance. Like, and Powell always does the same thing. He'll say, something like, "Well, we're going to be, we're going to be flexible, and we're gonna go with the data, and the American citizen is our top priority." He just all of his statements are like that. He's constantly. I have a love hate relationship with his comments because I know he has to do it. Obviously, he can't just give out some random fucking info in the press conference that would like change the course of markets that day. But it is also funny when he's just constantly saying, what was the thing he said? I made a comment about it. He said something like, "Look, he's like, look, I'm not going to put numbers on it." It's like, J-Pal, Papa Pal, your job is to put numbers on things. Like, at least phrase it better. But I can't be too hard on him, particularly after this meeting, because 75 basis points was absolutely the call. 50 would have been, I think 50 could have been pretty dangerous because I don't think that's enough, first of all, or wouldn't have been enough. And could have spooked the markets in one direction. And not quite going to a full 1% jump would have spooked the markets in the other direction. So I've said a lot of shit about Powell and the Fed, and all last summer I was screaming at them, "What the fuck are you guys doing?" Like, I'm no economist, but I saw this shit coming. This was the right call though, and I can't be mad at them this meeting. So he's a silly guy, but they made the right call this time, and we'll have to see what July brings, and then I'll have more comments on that. Okay, so let's quickly get into the charts. Let's do crypto first, even though I was on the S&P. Okay. Bitcoin. So we're in kind of like, fuck it, we're doing it live mode because I did look at TradingView before starting the stream, but I haven't gone into like some of the full numbers. You can see my meme line at 21,960. It held, bless its heart. It tried, but the meme line failed. So yeah, what to talk about on this chart? Right now we had the daily close below that low on just June 14th, a couple of days ago. Obviously, closing below any low on the chart is not ideal. That's the kind of hard hitting commentary you're watching the stream for. But no, closing below that low, not great for the future. But so far, yesterday's low is holding, and as minor as it seems, it's a good thing, overall. This is how bottoms form. One thing to note is that we do not. Sorry, real quick before I go into my next point. I've been sort of talking about how 20K, 20,000 is not a true level of support. I've been saying that the past few days that the actual the real support is actually just a little bit less at 19.5 if you go back in the years. Obviously the top over here, you've got 19, that was 19.4, so 19.5, we'll just call it that. You've also got over here back just before the hyper bull run in late 2020. You can see that we spent so much time below 20, I wasn't in Bitcoin. Bitcoin spent so much time below 20, sort of building up the rocket fuel to get above it, that this level is going to be, I'm on it right now. It's right around 19.4, 19.5. Algorithms, bots should want to touch that. And so it doesn't have to, but boy, does it seem like they would want to. However, I think it's important to call out when we're wrong. And so far I have been wrong because, bottom of, I think it was 20,000, like 50, 20,071 was the low for this year, which was just a couple days ago. So as of now, I'm wrong. And you know what? Maybe 20K holds. Maybe that psychological barrier is enough, and it zooms out of it. For ETH, ETH is tough right now. I've talked to a few people again about zones. I've called out this. We're in it right now, so there's not really a ton to talk about. But 1050 to 1250 is certainly where you can see. Oh, I turned off volume. Crap. There's volume. Okay, it's back on the chart, so you can see where the volume profile comes in. It's a big green one from January 21. It's been that's going to be a major one there since we broke through the next largest peak, which was at, gosh, way up there at 2,500 or something. Anyway, but we're talking about this one. So you've got about 1250 over here to 1050, a little bit below on that candle. I would probably gravitate towards testing this low, or sorry, we've already gone through it, but as for being the bottom of the zone, this low sort of in that January that wasn't a scam wick, 1040, 1050. So 1050 to 1250 is roughly that first zone. Below that, going back to sort of this area where we spent a lot of time after the peak sort of trying to not die in the 2018 market. That failed, but you're looking at 900 to, and sorry, I'm looking at the volume and where support was. So volume came up, it was on this candle, to close of 730, so we'll call it 750. And then this one's not based on the volume shelf. This is just based on geometric support. You've got, of course, 800, 830, and the top of it is 9. It's your call, but 910 to 950 in general. I don't know what the exact numbers are going to be, but 750 to 950, I think, would be the next big zone. So once again, what you're hearing me say is like similar to Bitcoin. I don't think 1000 is necessarily a huge support, because it's a psychological one, and traditionally those are weaker, because they're human made and bots are doing most of this trading at this point, especially when they're doing the punishing. So, I think successive closes below 1050, I think you blow through 1000, and I think you head straight for you probably start to sting down into the gap. So probably around, at least 900. I think 900 would come first, and then maybe you play around, 1000, kind of like we're doing with 1100 to 1200. But more importantly, unfortunately, ETH didn't gather quite enough steam this cycle to escape the ratio. So let's talk about that next and kind of just see where we're at. Oh, look, I drew an inflection line. Was that from the last stream? Yeah, I think it was. So yeah, 0.05 is just undeniably massive. It's a huge inflection point for the market. Markets love symmetry. You can already see, like, look at this sort of weird ass Bart Simpson top of his head, a big old year-long Bart. Whether we break it or not, it's possible. I was speculating last time that 05 is of course a massive inflection point. You can see it going all the way back. Look at these battles around it, all the way from when we first broke through in March 2017. It was resistance here in December 2017, and then it was an inflection point where once we broke it in August of 2018, it was down only for a while. So 0.05 is it's a huge battle. After that, I think it's going to be if it breaks, I do think there's a bit of dead air until, really this 0.04, going off geometry here, not volume shelves. 0.04, 04, maybe 03, basically 0.04. Let's just call it that for ease of explanation. This is probably going to be your next shelf. I guess you could sting down to this sort of 03. We're splitting hairs here. What's the difference between 038 and 04? We're all going to be in such a bad mood that day if it happens that we're not going to care. But yeah, okay. 038 was a top here in January 2019. You can see this is clearly an inflection point. Which coincides with the price inflection point from August 18. But this will probably be a little area, and it's right at 0.04, 041. That's why I'm saying these numbers. What was the other thing? Oh yeah, I was gonna really quick before we get, because equities is gonna be fast. Actually, let's do that first, because I do want to try to get better pacing with these streams. So I'm basically just gonna run down my list of what do I keep on my shortcuts. How do I look at the market? And really today, I'm not gonna say like, oh, markets went down. Obviously, everybody knows that markets went down. But I do want to check in on the divergences to see what's going on? Is everything is the divergence theory still in play? And the short answer is yes. But let's start with actually the muddiest of them all, the big old SPY, S&P 500. So I'm going to turn off volume to make this cleaner because we all know it's increasing volume. Red, downtrend, blah, blah, blah. Okay, we don't need that for this point. We're going to get it enough here. So right now we're on the daily. So we're on the SPY, which is the proxy fund for the S&P 500 index. And, you know, past few days I've been watching whether or not there was a divergence forming on the daily. It had held, Monday into yesterday. Sorry, 2 days ago. And it was looking like we would barely hold up. We need to hold above the May 12th bottom, which was at 31.79. We did hold it. Here was 31.96. We went up a little bit the prior candle, and then today, if you're watching, then yes, the daily divergence broke. And so, look, that's not gonna play out. And that's okay. What that can mean is, there can absolutely be more downside tomorrow, at least if you're going by the daily chart. But if we go to the weekly, and as with all things, on the larger time frames mean more. And a lot of shenaniganery can happen, intra-week, but overall, this is going to have more power to it. And if we go back to, again, that week, May 12th fell during this week. And so you can see here on the week of May 16th, RSI down here was at 30.28. And right now, after all this doom and gloom, somehow on the weekly, the divergence is holding up. We're at 30.58. So, I'm just imagining some absolutely crazy shit tomorrow with options expiry. They could sting it down, really, spook people off of this daily failing on the RSI, big gap down, red day, on volume, all kinds of crazy, scary stuff. Just imagine, where's my little drawing thing, imagine just like a big old, I guess I'll draw the end of the candle. Ah, yeah, look at that. Look at that. Just imagine a big old sting down to scare people. Like, right now we're at 3650, or just about 365, which I was talking about the other day. This is the make or break point, for the S&P 500. It's a big green line. I've had it drawn for months and months and months. Ah, crap. Get rid of that one. Zoom out. So I've had this green line drawn for a while. It's a massive inflection point. I mean, you want market symmetry? Look here. This is the start of the bull run, November 20. We're right there. You close below this, and I don't have any predictions. I just know that it's going to be unpredictable. I guess that's the right thing to say. Underneath this line is going to be unpredictability and uncertainty that we'll have to take day by day. But just imagine, they do all kinds of shenaniganery, scare the crap out of people, breaking this 365 point and touch down on, one of the stronger lines, I think 358 or 3580. What am I on? I'm on the SPY. I think 358 had some strength, if I remember correctly. It's the bottom of, is it the December low? No, it was so just before the close of November, it looks like. I do recall seeing on some of the analyst charts, yeah, it looks like there was a gap here at 358 that actually didn't close. Okay, that's interesting. Let's take a look at that, actually. Again, this is one of those live moments. So we're at the end of November. What was I just looking? Yeah, here it is. This is an unclosed gap on the daily, not even intraday. 358 up to 360. Gosh. Now, as we know, gaps fill because there's open orders there. It can take years, and God, now that I'm saying it live, like, what if, guys? And then it just rockets back up to close the week, save the weekly RSI. What a possibility that would be. So, just to summarize, SPY, the daily divergence broke. There's no more to say about that. it's not so much that I was wrong. It's just that the divergence I was tracking broke. It did set a new lower low on the RSI, but the weekly is intact for now, and we'll see what that turns out to be. Price action happening at close. As far as options expiry, I don't know when they actually are called. I thought it was like an hour before. What am I looking at? Looking for tomorrow. It's the see what time they're actually called. This should be. I don't want to go into there. Oh, good. This is where I wanted to go. So I think they are called right at 4:15. And that's New York time. So yeah, it's just going to be into the end of the day. So yeah, just to reiterate, so yeah, options will be they're going to be trying to hit. They're going to be closing out their options books right up till the end. And so the volatility could go all the way to the end. And so I drew this little thing. I don't know if this is going to happen. Look, this thing can plummet. Actually, it wouldn't be there on the weekly. It would be on there on the daily. This thing can keep going. With a lower low RSI, there's nothing guaranteeing this. I'm just saying, like, wow, what if? Like, what an ending! Like, what a end to the quarter that would be, especially given the market symmetry. And yeah, if they shoot that gap that we found back at the start of the bull market, end of November, which I had from, I'm just gonna put it on the chart. How do I do this? How do I do this easily? Drew a bunch of lines. I'm just gonna put it there to see if it bounces off. Is it like 358? I'm just gonna put it on here just for fun. Like, what? God, what if they do that? What a crazy call that would be. What a crazy end to the week, to the quarter would be. So that's the SPY. Again, daily divergence broken. Weekly divergence is still intact. I'm going to go through the bullish divergences first, and then I'll come back for the revert for what are still bullish, but the divergences on things like the dollar and the VIX. So next up, let's go to tech. Tech has both divergences still in play. We've got a low of 33.13 on the on June 13th daily candle, and yesterday's closed at 34, and with a lower low on the price. So for those who are just sort of tuning in to this sort of thing, divergence meaning lower low on price. Oh, that is an ugly line. Can we make that white? So I'm not showing green or red, so I'm not confusing anybody. So yeah, lower low on price, and look at this little higher low. Wow, that's blocking. That's blocking what I wanted to show. But anyway, I'll just draw it up here. Higher low on the RSI is what I mean by a bullish divergence. So it's playing out on the daily. Get rid of that. I'll get rid of that dot. And it's also, of course, playing out on the weekly. We've got a low of 28.51 on the week of May 16th. And so far we're at 29.51. So again, weekly divergence, we've got a lower low on the price and higher low on the RSI. So that is QQQ Tech. That would suggest that this is the bottoming process. It would suggest that up is coming. Divergences do not always have to play out. Price action is king. If this thing plummets, if the SPY goes through 365 and closes below, this thing can all drop. But bullish divergences are one thing we watch. They predicted the top. Here was the higher low over here back from August to November for tech, and also ironically for crypto, or coincidentally for crypto. We had a 75.23 in the end of August, and only 73.26. 73 actually when the Nasdaq topped, when tech topped. So look, a divergence started this whole thing. There's no reason to think that a divergence can't end this sort of thing. Right now, we may have one. And so that's on QQQ Tech. And the last one for the clear bullish divergences, I believe, is on the Dow. I'm looking at the DIA, the DIA, which is the proxy fund for the Dow, similar to SPY. It's just easier numbers to track. Right now we're on the Dow weekly, and we also have a divergence here. So you've got a low RSI of 29.4. This is a few weeks ago. And this week we've got, of course, a lower low in price, but a higher low in the RSI. It's 31.46 compared to 29.4. So again, lower low price, higher low RSI. Divergences aren't everything, but we do have a bullish divergence here. It would suggest that the Dow has bottomed or is about to bottom. On the daily, I can't remember if I checked this, so forgive me if there's not a divergence here. Let's see, we've got 33.17 back here in May. So we did put in lower lows on the daily. So there's no bullish divergence on the Dow daily. So that is one thing to note. We do then we are beholden to the weekly, which is a higher time frame, which is always good in terms of strength of the move. That's I would still call that a bullish divergence, similar to the SPY. The weekly is holding. I believe I checked this earlier. The next one is IWM, which is the proxy fund for the Russell 2000. That is the small caps. Typically, I call the small caps kind of the canary for the market. And I steal that from a lot of other analysts. I didn't come up with that because small caps are one of the first things to go in a risk-off market because they have the most risk. You don't know what a smaller company is going to be able to do with profits. Sorry, if I pause like that, I'm probably taking a sip of my apple juice. So let's take a look at this. I think I looked at this earlier and I wasn't pleased. So this is the IWM or small caps weekly. Right now we're at a lower low price and the RSI is at 28.68 and previous low 28.7. Beesh. So technically speaking, on paper, if we're going by the decimals, we do not have a bullish divergence on the weekly, and that means we probably don't have one on the daily either. That is correct. We have a lower low on the daily. I guess if you draw it all the way back, okay, hang on. If you draw it all the way back to the May 11th RSI low, which is 28.25, 28 and a quarter, we do have a divergence there. So I don't know how to parse that exactly. When the weekly is failing, but the daily actually has a divergence up. I take it to mean a little bit of strength in the bullish direction, probably not as strong as a full-on weekly divergence, but that is positive. So something to track. The other things. Let's do some of the reverse things that are bullish divergences, but that are in the reverse direction from equities market. So we've got DXY, which is the dollar, and so in this one we want negative divergences because typically speaking, the dollar trades in the opposite direction of equities. Not always, but generally speaking, and over a larger time frame. So on the DXY, we do have divergences forming. We are on the daily here, and you can see back over here on May 12th, DXY had an RSI of 74.3, and over here at a new high for the dollar, which is actually coming down, is a few days ago. I'll explain that in a second. But on the new price high for the dollar, it had a lower RSI of 70, peaked at 70.15. So that is a negative divergence. Higher price, lower RSI, typically would suggest that price action would start to come down next. It currently is. And one of the reasons for that may be that a lot of these the things that we're rooting for negative divergences on, we'll talk about the VIX in a second. They do tend to peak. They do tend to form a peak or a bottom before equities do. They give away their whereas a lot of things we track like moving averages and oscillators are forgetting the word. I promise I have not had too much apple juice. Lagging is the word I'm looking for. Typically, moving averages and oscillators are lagging indicators. Oftentimes, these markets that we're looking at for negative divergences are leading indicators. And so typically, the dollar will usually peak or bottom before equities react. VIX volatility, which we'll pull up. Oh, and real quick before I go to the VIX, the dollar is similarly Actually, the dollar is putting in a straight. Oh no, sorry, it did have a higher high in price with the spike. So of course on the weekly, the divergence is also playing out. I'm speaking too fast. I'm going to slow down. The divergence is also playing out. You've got a spike high to whatever it was, 106 the other day from that May top, and you do have a lower RSI on the weekly, 80.97 down to just below, right at 70, as I said that. So that is a negative divergence for the dollar. That is good for equities and should be good for crypto. I do want to say really quick before I get to the VIX is that crypto did follow the dollar a little bit more closely in its moves last summer when I was first complaining about the dollar starting to roar. And so hopefully if the dollar does, start to move down, maybe violently, if this divergence plays out, hopefully crypto doesn't follow it as it did last summer on the violence up, such as in June. We'll see. It's just one thing to note. Another thing that we're rooting for negative divergence on is, of course, the VIX, which is the index that tracks volatility, otherwise known as the fear index in the markets. It's how fearful the market is. It's how uncertain they feel on the week. So the VIX, because of the nature of it, you can see it in the way the candles form because it's a derivative of volatility. How do you form easy shapes out of that? But there is still a divergence to be tracked, and so you can kind of see going all the way back to here, sort of basically towards the equities top. It wasn't the crypto top. Crypto topped in like November 9th, I think it was, but a little bit later in the end of November with the Omicron spike. We got this RSI spike up to 67.86, 67.9, and that was on a lower price than it has been actually. So really, what's exciting about this is you've got this higher price, April 25th, and a lower RSI already, 61.7, below the 67, and now we're actually forming. Again, you got to kind of squint with charts like with like VIX because again, geometry doesn't quite work well with the way the candles form. But you do have a spike high here above that spike high of April 25th. So it's your call. But I would consider that a triple divergence, which is stronger. Sorry, it is stronger than just one with two peaks. And already we've got this spike high, which actually matched the November price high up here. Kind of looks very similar. But the RSI is again lower at 59.4, 59.38, even below April. So triple peak divergence with this sort of weekly gap, here, which I'm sure closed a couple times daily. Yeah, you've got this gap formed, which is going to help as well if the VIX does go down. Gaps act like I always compare it to the Mario Kart speed pads. If you can shoot the gap, it's just going to as I say, gap and go is really a popular term. You can bounce off gaps, which is the scary thing. That's what it's certainly possible that the VIX, taps 29.6 or whatever and keeps going up. It's one thing to look for. But boy, if it closes this gap at 27.75, generally what happens is that, you're going to get another spike down. So we'll see if that gap closes. It has only closed, it closed the first half of the gap on a closing basis and the second half of the gap intraday. And intraday is not as strong of a gap close, so I personally consider that still open. So that's one way that the VIX can move. Taking too long. Keep talking about same things over and over again. Let's move through. What was the last thing? Oh, 10-year yield is another one that we want. Obviously, yields have been spiking, and we all know what the markets have been doing. Oh, this is not the yield. This is the yield curve, actually, which isn't something that we track geometrically. Otherwise, it would just be insanity. You can see what the yield curve does and is starting to do. This is the dot-com bubble over here, popping, or leading up to the pop. This is the great financial crisis. This is COVID, and this is kind of what we're starting to do. Is this going to be, a COVID spike, or are we going to have, repeated flips of the yield curve? Don't know. Don't have an answer for you. It's just something to watch. It has already inverted. It inverted at the end of March, beginning of April. Typically, when the yield curve inverts, it leads to a recession in most of the cases. And in most of those cases, the recession happens somewhere 6 months to 2 years after the inversion, with the average being, I believe, just under 18 months. So a recession in 2023 it's awfully possible based on those statistics. Something to look at. But there's nothing to really track geometrically with the 10-year, or sorry, with the yield curve. Let's go to the 10-year itself. So here we are on the 10-year, and we're looking for divergences. We're on the weekly now, and look at that. We've got another one. RSI on that prior price high of May 2nd was 81.58. And we've currently got not only a higher price currently on close, but as well as the spike high. Got up to 3.5%. Goodness. We have a lower RSI right now, 73.48. So that is a higher high on price, lower high, lower value, I should say. Maybe not a lower high, but currently a lower high on RSI. That is a negative divergence. That is going to take a lot of pressure off of hopefully equities and crypto as well. On the daily, which I don't recall there being a divergence here. Yeah, we have confluence, which is good. So June 14th closed at a higher price and a higher RSI than we're at now. And after currently it's green, going up and forming a lower high. It's way too early to call. The market's just opened up, so nothing to hang our hat on. But yeah, right now looking like maybe just a lower high, bit of confluence there with the RSI. That'd be nice, but nothing to. We're not speculating on that right now. It's literally a brand new day. And so that should cover everything. Oh no, people wanted to talk. Oh man, so much stuff to talk about. I really got to get the pacing better on this. Really quick, let's go to corporate bonds. This one was interesting today. This is where I still hang on to some bullishness. Not only do we have divergences on the weekly, so here we are on corporate high yield bonds. Bonds, fastest, most powerful market on earth. We've got a RSI bottom on May 16th at 21.8. And today we've got a lower low price, but currently a higher low, higher value on the RSI, 28 compared to that 21.8. So lower low price, higher low RSI, that is a bullish divergence. And as we know, or as I've said, bonds, specifically high yield corporate bonds, I mean, they lead the way. This is where the money is. We're talking trillions of dollars compared to, the petty amounts that just the S&P 500 deals with. So bonds often can be a big indicator. And right now it's just, it's kind of in a spinning top, doji. But coming off that bullish divergence, it gives me a little bit of hope. And on the daily, I believe we have currently a higher low forming, which is nice to see. So again, June 13th, which is Monday. Monday, lowest low on both price and RSI. And after the spike, both 2 days ago and then yesterday's close, right now the value hasn't gotten, it's got a higher close, currently a higher close on the RSI. And compare that to something like the SPY, which looks a lot scarier. It's almost like I'd almost call it like a divergence between the charts themselves, because I guess if I had to put it in a word, I trust bond patterns more. I trust, because there's just so much fucking money in bonds, and that's where all the market makers are. I almost trust this pattern more. And so compare that to, the SPY, which has just geometrically speaking, lower low, scary candle that closed yesterday, compared to that high yield bond. It tells me that market makers are a little more confident, especially considering that's a bit of a hammer candle. And the weekly, as we said, is currently a spinning top, which can break either way. So if they get back above, 74 and a quarter, be it tomorrow or next week, more likely next week to, shoot this gap right here that's forming intraday, that could be the end of it. That could be the way the bottom forms. So yeah, high yield bonds, you've got divergences, and then on the daily, you've got just straight up bullish confluence, not even a divergence, a straight up confluence, convergence, I guess, if you wanted to use a matching word to divergence. It gives me a little bit of hope that this could be the bottom, and goes along with our theory that, these divergences will play out. And so the next thing I know, folks wanted to discuss oil. Oil, I've just because I'm a chart person, and the petrodollar is not my wheelhouse. I know how it came about. I know generally how it functions, but I'm not an expert on it. I've been treating oil basically. Okay, let me restart. Let me take a sip, and then I'm going to restart that statement. Oh, good. A little bit of apple juice in my keyboard. That's always good. Okay, so held a previous view that maybe crypto was moving in confluence with oil because, like, oh, we're a commodity, they're a commodity, or at least we had been. I look, ETH is a commodity to me. It's it's a triple point asset, but clearly markets don't treat it that way. They treat us as risk on. I don't think there's any argument anymore. We'd all love to say, for Bitcoin maxis, it was that Bitcoin was an inflation hedge. For Ethereum, I do believe that we're a triple point asset, but look, we're not trading like one. Bitcoin is not trading like an inflation hedge. We need to, if you're here for the finance portion, we do need to speak, their language. As much as I love ETH and as much as I believe it's triple point asset, it doesn't trade like one. So I had held a previous view that we would trade with oil. It sure looked like it. Uh, as oil was going on its run, through the end of 2021. I mean, like, look at this. It's natural to think, oil came off a bottom in August. We had that sort of, we had a September uh, uh, dip, and then from the end of September, October was all ours to move with oil, and then it just stopped. So I think the theory died the day of Omicron because just look at this run. If you follow the charts at all, I mean, energy has just been the only thing performing in this market, and boy, is it performing. I mean, oil's off the bottom of 48 and currently trading up at 87 on this index. This is for U.S. oil, and I can pull up Brent as well, but it's going to look pretty similar. But we can still look for divergences. And so this is probably, I believe USO tracks West Texas oil, or at least oil futures. And so it'll give us what we want to look at, which is the divergence here, and it's a negative one. So look, if we trade opposite to oil like we've been doing for the past 6, 7, 8 months now, then we have to be a little bit happy about this. Take a look at this. So we've got not only a negative divergence, we're on a weekly. So this is US oil weekly. We've got an RSI top of 82.6, 82.7. That was back in February. We've got a much higher high now because I drive an electric vehicle, but I do feel for everybody still filling up gas. It's not fun and it's bullshit. Profiteering and greed from oil companies. Woo, sorry, went off on a tangent there. We do have a higher high currently on price, but we have a lower high on the RSI down at 74. So that's 82.7 down to currently a top of 74. Higher high, lower high. That is a negative divergence. We should be fairly happy about that. If we're trading negative to oil, then a drop in oil, which is what a negative divergence would suggest, then it would suggest the next moves, I should say, are down. It suggests a downtrend. Divergences do not always have to play out. You should not be trading this, if you don't know what you're doing. And of course, as always, this is not financial advice, but that's what the suggestion would be. You've also got this nice little gap. Look at that, from week of May 23rd to May 31. It closed intraday a couple days, but like I've been saying, gaps are designed to close, and if you shoot this gap, you get oil back down to $85. It suggests further downtrend, and maybe it starts to test these averages down here. Maybe it breaks down through those. Maybe the market bottoms and we start to go up again. Let's check on that gap intraday. So this is May 31st. Oh, I don't have to zoom that far out. It's right here. Gap isn't really showing up intraday very much. A little bit. Basically, it only still exists on a closing basis from 83 down to 82. Is that correct? Is that what I was saying on the weekly? No. Okay, so that's a different one. Okay, so they are a little bit different. So on a weekly closing basis, you still have a gap from looks like 87.7 down to 85.5. That's on a weekly closing basis. Absolutely can still play out. And on a daily basis, it's a different one. It must have closed on daily closing bases. I think I'm using that word correctly. There's a little bit of a gap down here, 83, 82. So gaps are magnetic. Hopefully it happens on the daily and the weekly as well. And so that's on US oil, where we've got divergences forming on the charts. As for news, let me pull up this bad boy. So I was trying to find. Sorry, that's really bright. They don't have night mode on CNBC. At least I don't think they do. Nope. All right. Well, it's just gonna be. We just won't stay on here very long. Anyway, the gist is that OPEC, which is the consortium that controls oil barrels and effectively prices all around the world, or almost all around the world, since they're not including Russia anymore. At the start of COVID, just after OPEC agreed to shut off some oil production because I don't know if anybody remembers, but oil was actually like it went negative in that it cost more to like hold on to oil than it did to sell. It was a really weird like month there. I wonder if it shows up on this chart. We can kind of look at that again. It's very funny. Well, it was funny for me. It wasn't funny for. It doesn't show up on the fun chart. It shows up on the actual oil barrels chart. But yeah, anyway, oil went negative, and yeah, so it cost more to literally hold a barrel of oil than you would make off of it. Anyway, OPEC shut off a lot of oil production due to that because prices were going haywire. They were plunging, and so now they've agreed to bring the supply back up to roughly pre-COVID numbers or start to get close to that. They'll be, as it says here, they'll be increasing production by 650. I don't know what the numbers really mean. I don't know how many barrels is like average. But basically they're turning on the spigot in July and then into August. So, to my mind, that just means, oil's coming back, supply is coming back, which means, prices, the price of oil at the very least should come down. Now, the price of gasoline at your pump is going to come down to, BP and Shell. So the less said about that, the better. But oil, the price per gallon should go down, and that should take some pressure off of the Dow via transports. So here we are on the Dow Transportation Index. Go down. Let's just go to a weekly chart. So just like everything else, the Dow Jones Transport Index has been in a downtrend. But you've also got, I believe, a divergence forming here. So again, transports are just one part of the Dow Jones portfolio. Transports are just like it sounds, transportation, vehicles and all that kind of stuff, shipping. And so it's heavily reliant on the price of gas because, profits and revenue change based on how much they're spending to physically move things, which comes down to how much gas costs. So kind of somebody call me out if I'm making the wrong analogy here, but similar to the way that yields and bank borrowing puts pressure on the tech sector, because that's how startups and high PE tech companies get their money is from bank borrowing. Similar to the way that yields put pressure on tech, oil more practically puts pressure on transports. That one makes even more sense than the tech bullshit. So hopefully that makes sense as I'm saying it. So not only do we have here on the Dow Jones Transportation Index a divergence here on the weekly, we've currently got an RSI low of 34.59 on this higher close to get this, a lower low price, and yes, on paper by the decimal, a higher value of RSI, 34.60 to 34.59. Ladies and gentlemen, that is technically speaking a positive divergence, a bullish divergence. Combine that with the news of OPEC, starting to increase output again, and hopefully traders wanting to get ahead of that. It's yet another tool in our belt that says maybe maybe this starts to bottom out. Maybe this carves out a bottom. You've also got this gap down here in the weekly. Last week closed. Doesn't really matter the number. 13,360, and this one opened up at 13,270. So a tiny gap, especially on a weekly basis, but a gap nonetheless. It looks like it closed intraday, but it's something that you could shoot through on a weekly closing basis. You can imagine maybe this oil news hits well, and you just get kind of like a Morningstar candle. It probably won't go that high. That's a little bit too optimistic, K-Brot, but you know what I'm saying. Maybe it's something like that. A little more realistic. A Morningstar candle back above the what is that? That's the 100 week. So that would certainly be pretty nice, and it seems possible based on this news with OPEC. If supply and demand works as it usually does with price, that would lead to less pressure on transports, and maybe it helps us with our divergence theory. Okay, I've been rambling for a while. I've said divergence a lot. I think I covered everything I wanted to in equities. Uh, oh, the last thing. This is more for funsies. If you guys don't want to stay on the stream, that's fine. I just want to talk a little bit about how I trade momentum. Again, none of this is trading advice. None of this is financial advice. This is just how I read charts, and I want to go all the way down to the 4-hour to kind of explain. And so right now we're on the Bitcoin USD chart on the 4-hour. I'm going to sort of explain how I see momentum working. It's probably a very childish way to do it, but it works for me. It's worked the entire bear market so far. And so, it might give you guys one other thing to think about. So again, we're on the 4-hour chart. The way I look at it is right now we're forming a bullish divergence on the regular RSI. This is for Bitcoin. You've got a low value of 12.4 here. We've got actually a triple divergence on the 4-hour, which is nice. You've got a lower price here, higher RSI, yet another lower price based on the way the last 4-hour candle closed, and still higher RSI. So that's a triple bullish divergence forming for Bitcoin on the USD chart. But I want to talk about the stochastic RSI up here, which is the momentum oscillator, and kind of how I see it. I thought this would be fun. What suggests that a trend is changing? For me, it's when I use these peaks of maximum bullishness, which is above 80, and maximum bearishness, which is below 20, and sort of what price the chart has tagged. And that's how I identify changes to trend. It's how I wake up and go to sleep, not stressed at all about, trades or longs or anything like that, because generally speaking, the 4-hour chart is enough time to get ahead of any trend change. And so how do I look at it? I see it. Again, it sounds like I'm a toddler with a crayon when I say this out loud, but this is really how I read the charts. So up here is maximum bullishness. When you cross into this maximum bullishness, if you want to change the trend, for me, you need to, in this bullishness zone, get above the last price at which the bullishness died off. So let's just talk about what that looks like on the chart. Here, it has to get above, for me, this price. When the momentum shifted last time out of maximum bullishness, somewhere in this area. If you go up to where the price was, it was right around 31.5. If you guys remember, it was a week back when crypto was starting to show heartbeat at the very least. It was Bitcoin was testing 32. I think Ethereum was up. I think we were back around 2,500 or. Oh gosh, we weren't even that high. We were just at 2,000. But just going off the Bitcoin chart, just because it had more volume and liquidity to it, all this time, and I wasn't posting on ETH Finance for personal reasons, but I was watching it, and I never got scared about my. I didn't have a short, or sorry, I did have a short open still as of that candle, but because it never got above this prior bullishness zone. You can see where the momentum dropped over here, and it was topping things like 32,000. And look, draw that line over, and even at maximum bullishness, it never got above it. Stopped at 31.5, and so no sweat off my back. There wasn't any change to the trend, and it went down and down and down. And it works, similarly in the same fashion. At maximum bearishness, if you want the downtrend to continue, or if you're coming off a bull trend and if you're a bear and you want to switch to a downtrend, you want to see this during this period of time at which it's bearish, you need to see lower price values. And of course, it goes without speaking, during this bearish period, it clearly got way lower than the last time it broke out of bearishness, which was roughly around June 3rd at this time. You saw the price levels around 29.5, and it just plunged through it. So, of course, the downtrend was destined to continue really as soon as it got down through 29.5. And the less said about that, the better. So how do we break this downtrend? For me, it's, things like bullish divergences here on the standard RSI are, of course, a great way. This could be the bottom. I'm not calling bottom, but this is how bottoms form. And another way to see, another tool in our belt to see if the downtrend can break is if the Stoke follows that pattern I've been talking about. So, we were just at maximum bullishness. Again, I say I'm not in Bitcoin, but Ethereum follows Bitcoin right now. During maximum bullishness, it would have had to get above, roughly. Again, it depends how you want to read the chart, either 31.5 or perhaps the exact moment it broke down through momentum, which the close of this candle over here was 29.5. I should have known that. So you could say that, during this bullish period, if this candle, if it had, wavered around here, but ultimately worked its way back up to 29.5, you might have a case for saying the downtrend is broken. And for me personally, I mean, 31.5 certainly would have done it. If you got above 31.5 while Bitcoin was still in its bullish phase, that's a pretty good sign that the trend is changing. As of now, it's heading down. It can always flip back up, but generally speaking, it has to get above at least 29.5, and for me, 31.5. It has to get above this zone before breaking back down into bearish, because once the bearish momentum starts again, then the clock resets, and all you have to do is get below, I guess, the low of the prior bearish period breaking out, which was, again, 22,000. It's already well below there. So I don't actually, now I know I'm live right now, so I don't know how to parse that when the bullish period only gets up to the end of the bearish period of momentum. That seems, I don't know, at first blush that seems more bearish, but maybe that's just how you carve out bottoms. But just to look forward, so forgetting about the June 6th week, how could I see this downtrend ending based on that wacko toddler theory I just proposed to you guys about bullish and bearish zones? Well, let's say that this momentum down here keeps trending bearish. Maybe it even breaks down into full bearish territory and just it just touches on that 19.5 point of strength. But that's all it gets. That's all the bears get. Starts to turn back up. This is a much easier value. 22.5 is much easier for a Bitcoin spike to hit next time it enters the bullish zone than way up here at 31.5. I've been in the space a while. Believe me, I know Bitcoin can put in a $10,000 1 hour candle. I've seen it happen. It can absolutely do that. But I think it goes without saying that it's much easier for it to break above just what was this breakdown candle? Somewhere in the 22,000 zone. Basically, let's just say 22,000 for the breakdown candle. It's much easier for it to break through that should it stay around this price point as momentum drops next time around. And so, to me, that's how downtrends can end. Is basically just the bear trend. The downtrend fizzles out. Maybe momentum goes bearish briefly, and then just starts spiking back up, and it achieves this really easy value of 22,000. Okay, and that's my theory on stochastic RSI. That's how I read charts. When I post my crap in ETH Finance Daily, when I say things like momentum and trends breaking, this is what I'm talking about. And so the theory has worked really well since December, from the 4 hour chart all the way to the daily chart. You can pull up here. Here was like the daily bullishness. Never even got close to spiking back to, if you consider this the bullish range, it barely was that, April fake out of like 40,000. You can see it works on the daily chart. I don't know if it works on the weekly. I think the weekly might be actually too strong for the stochastic to work like that. Maybe. But that's how I see it. 4 hour chart is personally where I trade. None of this is trading advice or financial advice, but that's how I see it. And that should wrap it up for me. I'll try to do another stream tomorrow after close or the day after. Again, I'm going to call it the lay of the land, because we're going to have the options expiry, and we're going to get the weekly candle the weekly candle for equities, not crypto. That happens on Sunday at 0 UTC, but we'll get the equities close, and we'll have the lay of the land. We're going to know if this weekly divergence is going to hold. There's not a ton left. You're very welcome for showing you. Well, I showed you some things that are printed on the charts, which are, and then I also talked about my wackadoo theory about stochastic RSI. But you're very welcome. Anybody have questions before I shut this down? Gonna take that as a no. So hit me up on the ETH Finance Daily if you have any other questions or you want me to look at something in particular that I didn't cover in this stream. Otherwise, thank you guys for joining me, and I will see you next time. Oh yes, tomorrow It's my opinion. Tomorrow we'll have a better idea because it's just gonna be an end to this crazy week. So we'll get a daily close, we'll get a weekly close on equities, and we should have a better lay of the land. Cool. All right. I will see you guys on ETH Finance, and next time I get a chance to stream. I've been Kbrot, and this was 51% attack.